Hi, and welcome to this video. Would you like to be able to use fair value gaps and inverse fair value gaps to predict every single move in the market? Then you have come to the right video. And no, this is not impossible. And after this video, I'm sure you will understand. So if you would like to hit trades like these, which I took, presented to my students, and always prove execution for, then make sure to stick around, put away your phone, because this video might just be the most helpful video that you've come across. And if you don't have the attention span of a goldfish, then at the end, I will make you very happy with another little present of mine. We are going to be talking about what is a fair value gap and an inverse fair value gap for those of you who don't know about that yet, valid versus invalid setups, entries, management, and exits. And then, like I said, at the end, I will have a little present for you. So before we get into fair value gaps, we need to go into some of the logic behind what a fair value gap is and behind what an inverse fair value gap is. Before we can do that, we need to understand imbalance. Now, what is imbalance? Imbalance is basically the market making a very harsh move, leaving behind a bunch of unfulfilled orders. Now, this will usually look something like this. You will have a very big candle with, to the left, we do not see any volume, right? We do not see that there is a wick to the left of this middle candle right here. And to the right, there is also no wick or candle body. This usually means that there is a lot of movement to the upside combined with momentum. Before we can confirm that imbalance is there, we need to have three specific candle closures. And this can work on any time frame, by the way. We have candle number one, which is just a candle that goes right before the imbalance candle. We have candle number two, which will in essence form the imbalance once it's confirmed. And then we have candle number three. And once that one closes, we have a confirmed area of imbalance. Now, let me show you what this looks like on the chart. Right here, as you can see, we have quite beautiful movement to the upside. Now, can you already spot the imbalances? Exactly, they are right there. So I marked all of these out. We have this imbalance, and this imbalance. So now you know how imbalance works. Let's actually cover how we can identify fair value gaps. To do so, we first need to learn about equilibrium. You've probably heard this word in the ICT space quite a few times, but what exactly is equilibrium? This right here basically explains equilibrium, but let's face it, this is just too complicated. Let's really dumb it down a little because I love simple things. Right here, what is equilibrium? Equilibrium is the exact middle of price, meaning it is not a premium, it is not a discount, it is the exact average equilibrium, the middle. So basically the 50% level of a move from a high to a low or from a low to a high, the middle of that is our equilibrium. Everything above equilibrium, if we want to be buying, is going to be in a premium. We don't want to be buying in a premium, but where do we want to buy? We want to buy in a discount, right? Makes sense? So in essence, let's say we have a move that starts here at the high, moves to the lower end, where is our equilibrium? Right in the middle of that move. It's as simple as that. So right here, we have a little example. Here we have equilibrium and we have our imbalances. Before a fair value gap becomes a fair value gap, it needs to be at fair value. So if we want to be buying and we know that a fair value gap is basically an imbalance, but at a fair price, knowing that below equilibrium is discount and above equilibrium is premium, if we want to buy in a discount, which one of these three imbalances are fair value gap? I'll give you a quick second to think about it. All right, here we go. Boom. The bottom two here are fair value gaps. It's as simple as that. So you define a fair value gap by putting imbalances on the charts and then establishing what is equilibrium. How do you do this? Use the FIB tool, disable all other levels than the 50% level and the 0 and the 1 level. It's that simple, and boom, you get your middle line and your equilibrium. Now we have to ask ourselves, what makes a fair value gap valid? The first thing we need to have is a sweep of liquidity. Yes, that's very important. It's not just important in the ICT space, but in everything that I teach as well. In the institutional trading space, liquidity purchases are super important. Here, for example, we have a nice liquidity sweep, meaning that these fair value gaps right here are valid. But of course, we need one more element. We need the market structure shift. This basically confirms that the fair value gap is valid. Right here, we have the sweep, price displaces to the highs, and we have a market structure shift, meaning that these fair value gaps hold weight. These are actually valid fair value gaps. Now, the market structure shift is something very complicated, and a lot of my students are basically struggling with it, so I'll give you a quick explanation. When is a market structure shift valid? A market structure shift is valid if it's the high or low being violated that made the push higher or lower. So in this instance, this right here is the high that broke structure here on the lower end, swept that liquidity, and then we have that reversal. As soon as that specific high is broken, we have our market structure shift. So it is not this high right here because as we can see, this low did not break the previous low, meaning that this high is of no relevance. So this right here is not yet the market structure shift. And then for a fair value gap to basically be valid and for us to be able to take entries off of it, we're going to need one more thing, which is going to be displacement. Now, what is displacement? I hear a lot of people overcomplicating it way too much. It's very simple. Displacement is when price breaks aggressively through your point of the market structure shift. At that point, you have displacement. It's that simple. So now we know all these things, we can now start thinking about the entry. Let's cover the entry. First, we have our sweep. We have our market structure shift, we have our displacement, we know where our equilibrium is, we know where our fair value gaps are, we know our premium and discount. So where do we enter? We enter right here. Now, our stop loss and TP placement are very simple. Our TP placement is simply going to be the nearest liquidity and our stop loss is going to be right below the sweep. Because if we know that the market already took liquidity here on the downside, there is no need for price to go back there. We could violate this low, no problem with that because we could be rebalancing this fair value gap before moving to the highs. But what is very logical and where your edge will be is in the fact that we had a sweep here, so price doesn't need to go back here. And of course, since we didn't purge in liquidity, this can easily be our take profit. So this is what the entry and exit would look like. You have your sweep, price pushes upwards, market structure shift, tap into the fair value gap, you take your entry and price rides to the highs. Simple, right? So let's quickly summarize. We need a sweep, we need imbalance, we need displacement, we need a market structure shift, we need to map our equilibrium, define premium and discount zones, and enter from the fair value gaps, meaning the gaps that are in your premium or discount zone, of course, depending whether you're going to be selling or buying. And then for TP and stop loss, very simple. Your stop loss is going to be below the sweep or above the sweep, and your TP is going to be the nearest liquidity. All right, so now it's time to talk about the inverse fair value gap. And trust me, once I finish this and you learned about this, you will be able to combine both of them and basically read every single move the market is going to make. You're going to be able to predict how the market moves super easily. What is an inverse fair value gap? First, we need to quickly think back about imbalances. If we look at the previous entry that we took fair value gap wise, we can see that right here we had a bit of imbalance as well. That is what we call the inverse fair value gap as soon as we know that there was a sweep right here. So here we can see we had a little sweep, price pushed lower, creating an FVG, and at the point where we are starting to violate that which once was an FVG, we can start calling that an inverse fair value gap. And now the following examples will definitely clear it up, entry wise and also management wise at the end. Let's quickly talk about when is a iFVG confirmed. So when can we actually take an entry and when have we actually inverted a fair value gap? We have inverted a fair value gap once we get a closure above or below that fair value gap. So in this instance right here, we have our previous fair value gap. We violated right here because this candle, this closed within the fair value gap. So this is not a confirmation. Right here, once we close above that fair value gap, we get an inverse fair value gap, so an iFVG. It's that simple. Now, when is an iFVG valid? It is only valid once again we have that purge on liquidity. So we always need that liquidity sweep. If we didn't take out the lows here and price started to reverse, we are not going to be taking entries because we can just assume that we're probably going to sweep something on the buy side for us to then come back to the sell side to take out the liquidity that we were building. So what are some confluences that you can use which will make your trades become way more high probable, meaning that you will score a higher win rate? It's very simple. We get a market structure shift again and we leave behind imbalance. If you have these two combined, you have a very high chance of winning this specific. So where could you, for example, take an entry off of the inversion fair value gap? Simply as soon as we have the iFVG confirmed. So as soon as we close above that previous fair value gap, can actually think about entering already. Now I hear you thinking, so what do I target? Because all of this price action isn't printed yet, right? Exactly, it isn't. So what do we need to do? We need to go and look at the left-hand side. So here on the left-hand side, what we can see is that we're building a beautiful channel or a beautiful trend line, which we know is pure liquidity. So what can we do? We can simply target the top of that buildup of liquidity and set our TP there. And our stop loss, where does it go? Again, it goes right below the previous liquidity sweep. Now, I hear you thinking this is probably a coincidence, right? Now, let me tell you, this is actually recorded on Friday. Today is Saturday as I'm making this video, so I didn't cherry pick anything. I literally went to the charts, grabbed a screenshot, screenshot and found this iFVG in there. And to give you an even more stronger example, look at the left here. What do we see? Right here, we had another inverse fair value gap, which was confirmed right here. Could have taken a buy off of that. We know that we swept liquidity here and we broke structure. So our stop loss goes right here. Take a buy. How does it look like? We have two beautiful entries, one entry netting us around 3R and then one entry netting us around 1R. Beautiful, right? So let us summarize the iFVG again. We need a sweep, possibly some displacement. We need to violate an FVG and imbalance for this confirmed. We can use the market structure shift and an imbalance as a confluence. We enter on a violation candle closure. So meaning we enter as soon as we violate a certain bit of imbalance, as soon as we close above or below that imbalance. The TP is going to be the nearest liquidity and the sweep is going to be our stop loss. Now let me tell you how we can use this together and how we can use it to manage each and every position. After I explain this to you, you're going to be able to take entries off of fair value gaps. You're going to be able to take entries off of inverse fair value gaps. But what's more important, you're going to be able to manage each and every position based off of them. So you can take an iFVG entry and manage it based on the logic of the FVG. And trust me, don't take my word for it. After this video, I challenge you to go to the charts and look at it yourself. Let us take this as an example right here. Here we can see we have a sweep on liquidity on the lows right here. We have a market structure shift and we leave behind a beautiful fair value gap. Price comes back, mitigates that FVG. So we can take an entry. We take a buy right here and price starts reacting. Now, as we know, as soon as price starts leaving here, we can look at this and mark that out as a potential inversion fair value gap if price closes below that. So this FVG is not yet an iFVG, but we can start monitoring this FVG. And as soon as we violate this one, you could start thinking that price might just reverse. So how would that look like? Right here, we can see we had a sweep in our structure. We can also see that we've started to react to this fair value gap, which we have right here. Price then starts reacting even further. And as you can see, we violate this previous fair value gap, which we took an entry off of. And this is the only fair value gap in this specific price range, meaning that it is in our best interest to exit the position. Because as we know, we have everything we need in order for us to take shorts. So what could you simply do? You could simply exit your buy. Exiting that buy right here would mean that you are exiting at around break even, so you don't even lose anything. You can even start thinking about taking a short because again, we have all the elements that we need in play right here. What would the alternative be of not managing your position? The alternative would be that you lose -1R instead of not losing anything at all. Now, I really challenge you to go to the charts and tell me, what do you see? Please leave a comment below and tell me if you consistently see these things happening. All right, so now the moment that I really promised here, I am going to be giving away something to you guys for free. I created a webinar where I basically outline exactly how the markets work. I am going to explain to you why every single strategy that you have tried so far is likely not a profitable strategy. I will be covering the 5 most common strategies, highlight their problems, and then show you exactly how you can be trading. The spots to this webinar are absolutely limited, so I suggest you go into the description now, quickly click the link, and you will get access to that webinar for absolutely free, but do it quick so that you reserve a spot for yourself. Now, I hope this video was useful. If it was, I would really appreciate it if you could show me some love. First and foremost, if you want to see more content like this in the future, make sure to subscribe and check out my channel. I would really appreciate a follow on Twitter, kind of new on there, so I would really appreciate it if you would join my feed. I also have a pretty big Discord channel, which is absolutely free, where you will be able to follow the trades I take, where you will get announcements, possible discounts, and where you can always hit me up with a DM. And last but not least, I would really appreciate it if you could just leave a like and comment down below if you can consistently see these things on the charts as well. I am really looking forward to reading all of your comments and getting back to them. Guys, have a wonderful rest of your day and I will catch you in the next video. Bye bye.